All right, excellent. Well, thank you and welcome everyone to Managing Tax-Exempt Sales Advanced Strategies and Best Practices by Avalara. My name is Cameron Murphy. I'm a Senior Strategic Alliance Manager at Avalara, and we're going to go ahead and get going. So a little bit of a kind of safe harbor disclaimer. Further reminder that Avalara cannot provide legal tax advice, but we will answer as best we can some of the stuff. So we hope you find this discussion helpful. The session is for informational purposes only and not legal or tax advice. So a little bit about myself. I'm a Senior Strategic Alliance Manager, Senior SAM at Avalara. I focus on our strategic partnerships with our premier partners. So those folks that are aligned to Acumatica, I've been in that space, the acumatica space for about 5 years, and in the world of ERP for a little over 15 years. So enjoy working with both Acumatica and our premier partners. So let's go ahead and get going and see what we have for us today. So we are going to be covering a nexus implications and common exemption rules. We're going to go over some exemption sales use cases, some protocols for those exemption management, practices, strategies for audits, how to prep for those, and then how Avalara can help overall managing expiring exemption certificates. And then we'll have a question and answering at the end. So exempt sales and nexus. So really in the beginning, it was all about physical nexus. So first we started with that. Physical nexus for sales tax refers to businesses' tangible presence in a state that establishes its obligation to collect and remit sales tax. So this presence can take various forms, including things from physical locations, such as an office, store, warehouse, distribution center within the state. If you're employing any staff, sales representatives, independent contractors within the state, storing inventory, participating in trade shows. You can see here by our example, distributors selling nationwide, but with only 4 locations, usually only had to worry about tax compliance in those 4 states. So really, if you had a brick and mortar within the state, you had to collect and remit to the state now because you have triggered physical nexus. So that all changed in 2018 with the South Dakota versus Wayfair ruling. So really upended the tax compliance landscape. It used to be that businesses could sell in the states all over the country and often didn't have to concern themselves with collecting or remitting sales tax. That all changed with Supreme Court's South Dakota versus Wayfair in 2018, which established something called economic nexus. An economic nexus is based on its economic activity within the state. So a customer's economic activity within the state, even though it has no physical presence there. So in addition, prior to having to have a physical location, that brick and mortar, now all kinds of things come into play with economic nexus, click and mortar, all different kinds of things that now trigger it. So economic nexus is particularly significant in the area of e-commerce. So you can see here tax-free shopping on the internet became a thing of the past, and businesses now must collect across the country. So the net result of the Wayfair decision is that businesses everywhere need to pay attention to tax rules in every single state where they have sales. So let's take a look at some of those states and different economic nexus thresholds. So this is a map here of states that have used either a threshold based on revenue that's generated in the state or the amount of transactions or both. So you can see that Oregon and Montana have no, and New Hampshire, Delaware, they have no economic nexus. So they are just saying, we're going to sit this one out and see what happens. Other states there, like you can see, have a threshold of $100,000 in revenue within the state that triggers economic nexus. Now you're on the hook, an obligation to collect and remit to that state. There's others like California, Texas, New York that have both thresholds and revenue, 500,000 and 100 transactions within a calendar year. These are constantly changing. I've seen a lot of the rates get teased down to collect and remit more money to the state, really what they feel they are owed, because there's a windfall of what is actually being collected and what is being sent into the state. At any time, if there's any questions beyond this presentation, we do have a sales tax risk assessment. That is a document you can fill out about your business. We will go ahead and do analysis on it and show you where you have triggered economic nexus and where you are at risk and where you can take a look at mitigating that risk with our help. So economic nexus with exempt sales. So what does that mean? If they are exempt, that means a product has Exemptions that it is not taxed at 100%. So there may be a 20% product exemption. It's supposed to be taxed at 80%, or you think it's 60% and it's supposed to be 80%, and there's a 20% gap. So those exempt sales are included in thresholds. You can see here by the different states which ones. So exempt sales count towards your nexus threshold. So you may need to register and report those sales. And some of those states only count exemption sales of tangible personal property. Others include exempt services. And really, what at the end of the day, this requirement ensures transparency and compliance with state tax laws, particularly for industries dealing in wholesale goods, resale transactions, or exempt services. And at the end of the day, businesses must maintain proper exemption certificates for qualifying sales to avoid penalties and demonstrate compliance during audit. Our SaaS tool helps offload that, put it in the cloud, and check all of those exemptions as you generate an invoice, making sure that the tax is calculated correctly and any exemption certificates for products, services are taken into account. So nexus and exempt sales considerations, what are some of the big ones that we look at? Really the three here: inclusion of exempt sales in nexus calculations. So businesses selling primarily exempt products or services may unknowingly trigger nexus, which is now an obligation to collect or remit to the state. If registration and filing requirements, you're doing it on your own, it's manual. What questions do I have? Out of these exemptions, all of my sales, are some of those past the threshold? Are some of those under those? Where have I triggered economic nexus and I need to register now with those different states? And then state by state variability. Again, there's over 14,000 different product jurisdictions and rules out there that are changing. Those exemption rules differ by state, meaning a product or service considered exempt in one jurisdiction may not be taxable in another, or may. So a lot to look at. The three kind of pillars of nexus and exemption sales considerations, and really the burden of proof is on you. So while customers must provide documentation, the burden is on the seller during an audit to prove why this tax was not charged. So if someone comes on site, they say, I want you to pull invoices from this specific period. We're going to check the rates that were calculated and what was remitted to the state. Why were these calculated and why were they not? Why were they sold at this amount? And why do we only collect this much tax and remit it to the state? Your zero sales tax liability is tied to those documents as well. So that is something to keep in mind. And with fines and penalties, you can owe the state double the tax if you fail to collect. So let's look at something that would make a sale exempt. So exempt sale rules vary by state. They generally follow key principles to determine when a sale qualifies for sales tax exemption. Some big common reasons or exemptions there are if you're nonprofit, based maybe specific on your usage, your type of resale, any resale certificates, the type of structure of your business, and then direct payment permits. Maybe we are going direct to here and we have permits and documentation that say those exemptions are null and void. There are some other ones that you can see there: product-based exemptions, software as a service. Potentially it's calculated, I know in Texas at 80% instead of 100. Agriculture exemption, government stuff, different things that make really the makeup of sales exempt. So if we're looking specifically at drop shipping, which was a big and has been a big area of interest for us over the years, it really comes down to three different parties. So you have a third party, the manufacturer. That's the originator. That's the person that is putting the goods together, the supplier of it. They're going ahead and they're drop shipping it out to their vendor, their retailer, their storefront, distribution company, whatever that may be. And that person has the relationship with the customer. So it's going from that B2C, B2B, B2C, down to the customer, the end user. They have the final purchase on it. They go ahead and purchase from the vendor. The vendor has to now show proof that they have exemption certificates and they have accounted for all of those. And then also there may be some use tax with the manufacturer if things were assembled for the customer at the retail level. So when a manufacturer accepts an order from a retailer and the manufacturer delivers the goods to the customer on behalf of the retailer in the state where the manufacturer and customer have nexus. So those are big things to keep in mind when drop shipping. Those are big triggers for nexus now that we don't have to specifically rely on and worry and focus on just our brick and mortar. More of what states are we shipping into and where have we triggered those parts of it. So you can see here, sale one goes from the customer, retailer, or the retailer to the customer, or it can go to the manufacturer, the retailer, or they deliver it direct and you have that delivery direct documentation to really make yourself compliant and avoid any exemption audits. So you can see here the different parts that go at the end. The end user is the final purchaser, and a lot of the burden is on you, the seller. So expiring exemption certificates, how do we manage those? We have a whole bunch of them that are in boxes or file cabinets in our location, and we need to keep those up to date in real time. We know that we have some that are expiring. How do we manage that manually? The answer is it becomes very, very difficult and challenging. So some challenges in consideration, expiration dates and time periods can change at any time. Using Avalara, ECM, or exemption certificate management, being in the cloud now, relying on the communication integration to go back and forth in real time from your ERP, your point of sale, whatever it may be, to our tool. Just because the exemption certificate you collected in 2020 was originally good until 2025, that doesn't necessarily mean things can't change, and they can lower the time period from 5 years to maybe 2 or 3. And states have since started requiring renewals every 3 years. So constantly out there trying to keep you on your toes, making sure that we have really the state what is expected of nexus triggers collected and remitted to them, continually challenging that and changing those. How do we keep up with that? That's really going into a tool that can do the work for it. So best practice for managing expiring certificates. Pretty straight across the board. We have our cert capture, goes into exemption certificate management now, which is our ECM product. Request updates proactively, not after the certificate has expired. You use the software to track and flag any expiring certificates. And then in essence, bottom line, what it does is sets internal mandated renewal period, so you know when it's coming up, even if it's not required by the state to capture changes to this. So you're really taking a tool, offloading that work, and now you're able to focus on revenue generating events for the business and let our tool do the work for you in the back. So the cost of missing the exemption certificate. So here's a scenario, and this is just, the numbers are just out there so we can kind of showcase the different scenarios within missing that exemption certificate. Again, these numbers are not real-time numbers, but they're just shown for display. So your business is being audited. Someone comes on site. They say, I want to take a look at what was exempt, any certificates that you have, resale certificates, what was collected on these 10 invoices over this period in 3 months ago. The auditor reviews one of the month sample for an audit period of 36 months. They look at it. They say, hold on a second. This doesn't look accurate. What happened here? We feel that there is a gap in what was calculated, collected, remitted. They find a $15,000 sale with a missing or invalid certificate, resulting in uncollected tax revenue of 8% or $1,200. What happens next? That auditor assumes the amount of uncollected tax for each month during the period. So he does some math, looks at the penalty, says 8%, $1,200, the amount of the deal, and comes through, and he is now imposing an uncollected tax fine that's calculated $1,200 times 36 months, or $4,200. Again, these numbers are used to show what happens in this scenario of the cost of missing an exemption certificate. That's one certificate. So other audit penalties, fees can also apply. At the end of the day, this example, a single certificate could cost $4,200. We get calls from folks all day, all week, all the time that are either in this scenario or they're concerned about this, and we really have that discussion of where they're at in their business, where they're at in their processes, what they're looking to gather, what challenge they have, and what requirements, and how we can help. So we're always willing to do that with you all. Again, at the end of the day, reducing audit costs and saving time with Avalara. 4 big areas of things here that we look at the total economic impact of us from a 2024 report. 85% of Avalara users saw an 85% increase in audit preparation efficiency, saving 34 hours per audit. So 85% increase in preparation. That equates to 416 hours, which is the average number saved annually by using Avalara ECM or exemption certificate management. And again, a cost savings of around an average $210,000 in audit fees and reduced penalty, just from using Avalara over a 3-year period. It doesn't cost anything to have a discussion with us on how we can further help your business save and really, again, offload some of those hours and put those towards growing your business. And then over the years, assessments can be applied to transactions dating back many, many, many years. So again, having that tool in the cloud to go ahead and integrate with all the platforms, collect the exemptions digitally. Now using our AI-powered validation, which is even faster and more accurate. Again, it's secure. It's in the cloud. It automates the renewal notices, which we went over. Anything managed by the customer, the state, anything that changes, and you're able now to respond to audits very quickly with our intelligent exemption certificate management. So at the end of the day, it's collecting, validating, and maintaining exemption certificates. Any direct buyer documentation, anything that's needed, any insights. Now you have a centralized collaboration where you have a great dashboard and visibility into the compliance piece, the automation, and what moving parts. And then again, any invoice, websites, platforms that we need to integrate with, using those tax engines for real-time verification, and then enabling your e-commerce module, APIs, any professional services, any other areas that you need to collect digitally and use. We now have an extensive reference library of exemption laws, again, in the cloud and using AI-powered validation. So to wrap, ECM managed services, there's a couple different ways that we can go. I think the best way to go ahead and get started is to reach out to your acuMatica partner, your consulting partner, anyone that is maintaining your ERP, focused on acuMatica, having a discussion with us, seeing where we can help when it comes to calculating, collecting, remitting the tax part, and also making sure that we have in line a compliance piece now to our exemption certificates and how to manage those in real time and have those in the cloud. So the one-time managed services, or we can do a reoccurring ongoing maintenance, different things that we can do for implementation to get you up and running again in the cloud. So highly flexible, done in real time, and the calculations happen very, very fast. And we pride ourselves on working towards and having 100% accuracy for your business. So at the end of the day, you can move on and focus on things that are growing your business and getting the talented folks that you have focused on their roles and not any manual processes. So that is what we have today. I don't know if there's any questions in Q&A. I know we have a couple minutes here before we're at our time. So if there are, I will answer. Now we can adjourn.
Yeah, I haven't seen anything come across yet, Cameron, but like you said, you've got a few minutes left. So if anybody wants to know a question in the chat, please feel free to go ahead and do that. We'll just give them another few seconds or so, Cameron. But appreciate the presentation. Thank you very much.
Yeah, there's a lot of us there.
I'm like a little dizzy. That was
yes. Well, in closing, we are always available. So if there are any other questions, there are avenues to get a hold of us. Again, our folks that are aligned to talking to customers about what is going on. They really enjoyed learning the different scenarios and challenges and requirements of the business. And I just want to say thank you to the acuMatica community for the opportunity to present today. And hopefully those that were on got a little bit more visibility on how we can help. And we hope to hear from you in the near future.
All right, Cameron, appreciate it. Thank you very much.
Thank you so much. Have a great conference. Bye.